Did you know that nearly 90% of people who try to invest in the stock market end up losing money? Scary, right? But what if I told you there's a way to beat the odds and grow your wealth, even if you're just starting out? The secret is value investing. In 2025, it's still one of the most powerful strategies, and it's not just for the Wall Street pros. This video will show you how anyone can use value investing to start making smarter investment decisions. From spotting hidden gems in the market to using the latest tech to find opportunities, I'll walk you through the simple strategies you need to know. If you're new to investing, don't worry, I'll explain everything clearly, and you'll see how you can start building wealth even in a market that feels unpredictable. By the end, you'll understand what value investing is, why it works, and how you can start using it today to make your money work harder for you. So, if you're ready to stop making mistakes and start investing like the pros, keep watching. The future of your finances starts now. Chapter 1. The Secret Sauce. What value investing really means in 2025. When you hear the term value investing, you might think of Warren Buffett and stocks like Coca-Cola or Johnson & Johnson. But value investing has evolved for 2025, and it's not just about finding old, boring companies anymore. Value investing is about looking for stocks that are trading below their true worth, whether it's in a well-established industry or an emerging sector. The strategy remains timeless. Buy low, sell high, but now, you need to think beyond the traditional. In the past, value investors relied heavily on a company's financial statements, but in 2025, we're seeing the rise of alternative data. A report from Deloitte found that 70% of investment firms are using non-traditional data sources like social media sentiment, web traffic, or satellite images to gauge company performance. Value investing today isn't just about what's on the balance sheet, it's about seeing beyond the numbers. One thing that hasn't changed? The importance of patience. Benjamin Graham, who mentored Warren Buffett, once said, "The individual investor should act as an intelligent business owner and not as a speculator." In 2025, this means being patient while letting the market discover a company's real value over time. Value investing is also about finding companies that have a strong competitive advantage or economic moat that protects them from competitors. Think about Apple and its ecosystem or Tesla and its position in electric vehicles. These companies may seem expensive now, but their strong positions make them prime candidates for value investors. The world is different in 2025, companies are embracing technology, sustainability, and innovation. So, your value investing strategy needs to evolve. You might be looking at green energy stocks or artificial intelligence companies that are undervalued due to their market volatility. Remember, value is subjective. It's about finding opportunities that others overlook. Chapter 2. Hunt like a pro. The art of finding undervalued gems. Finding undervalued stocks isn't like picking up pennies from the ground. It requires a bit of detective work. In the past, you'd rely on ratios like price to earnings, P/E, and price to book, P/B, to spot undervaluation. These tools are still useful, but in 2025, we have a new world of tools at our disposal. Start by looking beyond the mainstream. The most undervalued stocks often aren't on the front pages of financial news. In fact, a study by Morningside Analytics showed that stocks with low media coverage tend to perform better in the long run. Why? Because they fly under the radar, allowing savvy investors to buy them at a bargain before they become the next big thing. Another powerful tool is AI-driven stock screeners. These tools can help you sift through thousands of stocks and find hidden gems. The good news? You don't have to be a tech wizard. Platforms like StockRover or Finviz offer easy-to-use screens that can pinpoint undervalued stocks based on multiple criteria. One underrated strategy in 2025 is looking for companies that are leading in new technologies. For instance, companies involved in the development of quantum computing or biotech innovations might be undervalued due to their high risk but potential high reward. Consider how early investors in tech giants like Amazon and Google once looked for similar signs in obscure sectors. Also, don't forget about cash-rich companies. Companies with a lot of cash on hand are often undervalued in times of market turmoil because investors focus on earnings rather than liquidity. Warren Buffett once said, "The most important thing to do if you find yourself in a hole is stop digging." A company with cash reserves isn't digging. They can weather downturns and come out on top. Lastly, look at insider activity. When company executives buy their own stock, it's often a good sign they believe in the future of the company. According to a study by the Wall Street Journal, stocks with heavy insider buying outperform the market by nearly 10% annually. Chapter 3. Risky business? How to play it safe in today's volatile markets. The idea that value investing minimizes risk is true, but it's important to adapt to today's volatile market. 2025 is different from any time before. Economic uncertainty, interest rate hikes, and market swings are common. However, with the right strategy, you can still minimize risk while pursuing opportunities. In a volatile market, diversification is your best friend. A balanced portfolio, across industries, asset classes, and geographies, can help smooth out the rough patches. Consider the example of a 2025 value investor who holds stocks in traditional industries like energy, but also keeps a close eye on emerging industries like renewable energy. By balancing the two, they can avoid the steep drops that might affect one sector while still participating in growth. Another approach to managing risk is focusing on companies with strong fundamentals. These include companies with consistent revenue, low debt, and a solid history of profitability. In times of economic downturn, these companies are more likely to survive and even thrive. For instance, in the 2008 financial crisis, companies like Microsoft and Johnson & Johnson, who were consistently profitable, came out stronger than most. If you want to minimize risk in 2025, consider adopting a buy and hold mentality. Too many beginners try to time the market, but studies show that long-term investing tends to outperform short-term strategies. According to a 2024 report from Vanguard, holding a diversified portfolio for at least 10 years increases the likelihood of positive returns by 80%. Another tip is to evaluate the intrinsic value of a company. If a stock is trading at a price that's far below its intrinsic value, it can be a sign of a good investment opportunity. This concept is called margin of safety and was a core part of Benjamin Graham's strategy. Even in volatile markets, this strategy helps minimize the risk of overpaying for a stock. Finally, always be prepared for market downturns. Recessions are a normal part of the market cycle, and during these times, even the best value stocks can temporarily lose value. But if you've done your homework, these dips can provide excellent buying opportunities. As Warren Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." Don't forget to subscribe. Stay tuned for the next chapters on how you can unlock value investing's true potential. Chapter 4. From Data to Dollars. How to use financial metrics in a digital world. In the world of value investing, numbers are everything. But in 2025, we're no longer just looking at the same old metrics. Financial metrics like price to earnings, P/E, ratios, debt to equity, and earnings per share, EPS, are still essential, but there are new ways to dive deeper into a company's health. Technology is transforming how we analyze stocks, so it's time to embrace it. Let's talk about ESG, environmental, social, and governance metrics. ESG investing is on the rise, with over $35 trillion invested in ESG-related assets globally as of 2025. These metrics measure how well a company manages risks and opportunities related to environmental, social, and governance factors. Companies with strong ESG performance are often seen as more stable, which fits perfectly into a value investing mindset. If a company has a robust ESG strategy, it could be undervalued in the market today. But ESG isn't the only new tool in the investor's toolbox. Artificial intelligence and machine learning are now part of the stock screening process. These technologies can analyze massive amounts of data in seconds, including news articles, social media posts, and financial reports. For example, AI tools like AlphaSense use natural language processing to detect trends in financial statements and earnings calls, helping investors make better decisions based on real-time insights. Another growing field is alternative data. This includes data sources like satellite images, supply chain data, and web traffic analytics. In 2025, investors are using satellite images to track things like parking lot traffic at big retailers to predict sales. Websites like Planefly or Orbital Insight have transformed how investors gather information. While not yet mainstream, these tools can offer valuable insights for value investors who are willing to dig deeper. And don't overlook insider transactions. When company executives buy shares, it's usually a sign they're confident about the company's future. Insider buying can be a strong signal that the stock is undervalued. A study by Open Insider found that stocks with significant insider purchases outperform the market by 10–20% over the next 12 months. Chapter 5. Don't follow the herd. Why patience is your ultimate superpower in 2025. It's easy to get swept up in the excitement of quick gains. From meme stocks to the latest crypto craze, it feels like everyone is chasing the next big thing. But value investing isn't about getting rich quick. It's about taking a long-term view and having the patience to let your investments grow. Think about Warren Buffett, who once said, "The stock market is a device for transferring money from the impatient to the patient." Buffett's philosophy has stood the test of time, and it's especially important in today's fast-moving markets. In a world where trends change overnight, value investors must have the discipline to stay focused on long-term potential. Patience also means resisting the urge to react to market noise. During times of uncertainty, like recessions or market crashes, many investors panic and sell their stocks. But history shows that the best time to invest is often when the market is down. For instance, those who invested in the stock market during the 2008 financial crisis have seen massive returns. According to a study by J.P. Morgan, the S&P 500 returned more than 300% from 2009 to 2025, proving that staying the course pays off. One key aspect of being patient is understanding the difference between price and value. Just because a stock is cheap doesn't mean it's a good investment. A company may be trading low due to temporary issues, but if it has strong fundamentals, it can bounce back. Value investors must have the discipline to avoid being lured by short-term fluctuations in price and instead focus on long-term value. Another way to practice patience is through dollar cost averaging, DCA. This strategy involves investing a fixed amount of money at regular intervals, regardless of the market's performance. DCA reduces the impact of volatility and removes the temptation to time the market. In fact, studies show that DCA can outperform trying to pick the perfect moment to buy. Lastly, never forget that value investing is about quality, not quantity. It's tempting to try to buy a lot of stocks to diversify, but a smaller, well-researched portfolio often leads to better results. Focus on a few companies you believe in and trust your research. As Peter Lynch, one of the most successful investors in history, said, "The key to making money in stocks is not to get scared out of them." Make sure to subscribe for more investing tips, and stay tuned for the next chapter. Chapter 6. Value Investing for the Future. How to prepare for tomorrow's world. The world of value investing is constantly changing. In 2025, it's not enough to simply rely on traditional industries. To stay ahead of the curve, you need to be ready for the companies of tomorrow. The future is digital, and the next big opportunity may not be a company that exists today. Consider sectors like artificial intelligence, renewable energy, and space exploration. These industries are still developing, but they have massive potential. For instance, the global market for AI is expected to grow from $387 billion in 2025 to over $1.8 trillion by 2030. Companies involved in AI development, like those in autonomous driving or robotics, could be trading below their true value if the market hasn't fully grasped their potential yet. Similarly, the push for renewable energy is only accelerating. With global governments committing to net zero emissions by 2050, companies in clean energy are positioned for massive growth. In fact, the global renewable energy market is projected to grow at a compound annual growth rate, CAGR, of 8% from 2025 to 2030. If you can find companies that are undervalued in this space, you could be investing in the future. Space exploration is another area to watch. While it may seem like science fiction, private companies like SpaceX, Blue Origin, and Rocket Lab are paving the way for a new era of space travel and exploration. These companies could revolutionize industries like telecommunications, transportation, and mining. As these industries mature, early investors will likely see huge returns. The key to value investing in the future is understanding the risks and rewards of new technologies. These companies may be risky, but their potential upside can make them worthwhile. As a value investor, you need to ask yourself, does this company have strong fundamentals? Is it positioned to grow over the long term? If the answer is yes, these newer, riskier sectors could offer some of the best investment opportunities. Ultimately, value investing in 2025 requires a balance between tradition and innovation. Stick to the principles of value investing, focus on strong fundamentals, long-term growth, and a margin of safety, but also be willing to embrace new industries and technologies. The future of value investing is out there, waiting for you to find it. Don't forget to subscribe for more insights on the future of investing.